Hey everyone, this is Bill, the founder of Gold Sale in FX. With over 10 years of experience in the markets, my mission is to educate, empower, and build a community of traders who strive for true mastery in Forex trading. Here I provide 100% back-tested proven strategies, most importantly alongside real market education. So you get to gain the knowledge, skills, and confidence to trade with consistently and also profitably. This is more than just a channel to me, it is a movement. So once again, I welcome you to Gold Stale in FX, where education meets mastery. Peace and blessings be upon you. Let's conquer the markets together. Welcome to the course. So, if you are completely new to Forex trading, or this is foreign to you, or even if you're a beginner, I congratulate you. Alright, because you are taking a step to actually understanding and gaining knowledge. Don't worry, I've got you covered. In this course, I'll walk you through everything you need to know to get started with Forex trading. I'll kick things off with the basics such as what Forex trading is, how it works, alright? Then I'll break down market structure for you and show you how currencies are traded in the real world. You will also be learning about brokers and how to choose the right one. Plus, I'll explain pips and lot size so you can understand how to manage your trades the right way. I'll also talk about spread and leverage and how they affect your trades. Plus, I'm going to take a deep dive into the charts, and most importantly, you will also understand when to use different types of charts to make better informed decisions. Lastly, I'll give you a quick overview of the three main types of analysis, which are technical, fundamental, and sentiment. Okay, so Forex trading, right? So what is Forex trading? So basically, Forex trading or the foreign exchange market is where global currencies are exchanged, making it the largest and most liquidated financial market in the world, with over 7 trillion traded daily. When I started trading, it was 5 trillion, right? And up to date now, it has been 7 trillion traded daily. And at its core, Forex is about capitalizing on price movements, which means buying when a currency is undervalued, okay, and selling when it gains strength, or vice versa. Unlike the stock market, Forex do run 24 hours a day, 5 days a week, driven by economic events, market sentiment, and global financial shifts. But here's the truth, okay? Trading isn't just about buying and selling. It's about knowledge, discipline, strategy. Without the right mindset and risk management, to be honest, the market can really be unforgiving. Okay, so moving on, now we are going to talk about market structure. Okay, so market structure is the foundation of price movement in the Forex market. So it basically helps us traders to identify the overall trend and anticipate where price is likely to move next. In simple terms, market structure is how price behaves over time, forming patterns of highs and lows that tells us if the market is trending up, down, or even ranging sideways, right? So understanding market structure gives you an edge, right? It allows you to trade with confidence rather than randomly entering trades based on guesses or emotions, right? So a lot of beginner traders, when you guys don't even know how to identify this market structure, you guys will just take trades based on the first thing you see, which is ridiculous. Every time you guys will get stopped out, every time you guys would think like, hey, why my trade is going wrong? So you need to understand market structure. It is so important. Even as a professional trader, market structure is everything, right? We will look at overall trend. We will trade based on what the trend gives us. We will trade based on a breakout of a trend. Yeah, so this is market structure. Three phases of market structure, and it is actually one of the most important things you need to master in Forex trading. All right, so why do we need to understand? So understanding market structure is key because once you can read the market like a book, all right, you'll know exactly what's happening and where price is likely headed next. Your anticipation will be much more accurate, right? Now, the market moves in three phases, which is uptrend, downtrend, and ranging market. Okay, First, we've got an uptrend. So as I bracket there, uptrend is called the bullish market. This is when price is making high highs and higher lows, meaning buyers are in control and the market is pushing up. Okay. Then there we have the downtrend, where price forms lower highs and lower lows, showing sellers are dominating, means sellers have the strength. And finally, we have a ranging market. So usually, a ranging market is price just moving sideways, bouncing between support and resistance level with no clear direction. Alright, so let's start with the uptrend, also known as the bullish market. This is when price is consistently making higher highs and higher lows, which basically means buyers are in control and the market is pushing higher. In an uptrend, price doesn't just shoot straight up, it moves in waves, pushing higher, pulling back slightly, then continuing up. This is where smart traders look for buying opportunities, usually at pullbacks or key support zones to catch up the next move. Let's talk about the downtrend, also known as the bearish market. This is when price is making lower highs, right, LH, and lower lows, LL, which tells us that sellers are in control, pushing the market lower. Just like an uptrend, price moves in waves, but this time it is dropping, pulling up back slightly, and then continuing downwards. Alright, so as traders, we look for selling opportunities at key resistance levels or during pullbacks to the trend line, so we can ride the momentum down. So now let's talk about the ranging market, also known as the consolidation or sideways market. This is when price isn't really trending up or down, it's just moving between a clear resistance zone at the top and a support zone at the bottom. Alright, in this phase, neither buyers nor sellers have full control. So price keeps bouncing between these levels, and traders, right, as us as retail traders, we would usually wait for a breakout, right, some sort of a breakout, because once price finally breaks out of that range, it can signal the start of a new trend. So it can break above the resistance level, which is a bullish breakout, or it can break below of the support level, which is a bearish breakout. Okay, so how currencies are being traded in the Forex market, right? So currencies are always traded in pairs, which means whenever you're buying one currency, you're selling another at the same time. Each pair represents the exchange rate between two economies. For example, when you're looking at Euro USD, you're comparing the Euro against the US dollar. If it's GBP JPY, that's the British pound versus the Japanese yen. Now, what makes Forex unique is that it is a decentralized global market. Unlike stocks, which trade on centralized exchanges, Forex operates through a massive network of banks, institutions, and retail traders, all speculating on price movements. And what actually causes this price to move, right? It is a mix of economic events, interest rate, geopolitical factors, and overall market sentiment, all of which that can create opportunities for traders to profit, right? So another big difference is Forex run 24 hours a day, 5 days a week, with trading sessions moving across major financial hubs like London, New York, Tokyo, and Sydney. This means that the market is always active and there's always potential for opportunity. Now, to navigate these price movements, traders usually use technical and fundamental analysis to find the best trade setups. But here's the thing, mastering Forex isn't just about placing trades. It's about understanding how money flows, how the global economies interact, and how to position yourself for long-term success. So there's many things when it comes to trading. And let's talk about brokers, all right, Forex brokers, because if you want to trade Forex, you definitely need a broker. Okay, but here's the thing, not all brokers are the same. Some are regulated, meaning they follow strict rules to protect your money, while others completely unregulated, which means your funds might not be as safe as you think. And in the worst case, some brokers have literally disappeared with traders' money overnight. Okay, it happens, right? So how do brokers actually work? And should you go for a regulated or a non-regulated broker, right? That's exactly what we're going to break down here. But by the end of this, you'll know what to look for in a broker, how to protect yourself from scams, and which type of broker suits your trading style. So what exactly is a Forex broker? Now, think of a broker as your gateway to the Forex market, right? It's like a door, an entry door. They are the ones who gives you access to buy and sell currencies, providing a trading platform and handle the execution of all your trades. But here's the thing, not all brokers operate the same way. Some offer tight spreads and fast execution, while others, well, let's just say they might not have your best interests at heart. And this is where the big difference comes in. There are two main types of broker, all right? Regulated and the non-regulated ones. One follows strict financial rules to protect your funds. The other, no rules, no oversight, just you hoping they play fair. So before you actually open an account, you need to really understand. It is so important. Let me say again, you need to understand how brokers work and choosing which one is actually right for you. So a regulated broker is monitored by financial authorities like the FCA in the UK, ASIC in Australia, CYSEC in Europe, and the CFTC in the US. And where I'm from, Singapore, a broker must be under MAS to be legit, right? Money Authority of Singapore. So why does this matter? Because regulated brokers follow strict rules to protect traders and to ensure fair trading, and most importantly, keep your money safe. They also have to segregate client funds, provide transparent pricing, and can't just vanish overnight with your deposit. If you're serious about trading and want peace of mind, a regulated broker is definitely your safest bet. But does that mean non-regulated brokers are always a bad choice? Well, let's talk about that next. Okay, so now let's talk about the non-regulated brokers, because this is where things gets a little tricky. Unlike regulated brokers, non-regulated brokers operate without oversight from major financial authorities, which means they don't have to follow strict rules. And while that might sound like more freedom, it also comes with more risk. Some of these brokers are legit, alright, because I have personally traded non-regulated brokers that are trustable and that has been in the industry for a very long time. Means they are quite reputable. There's no delay in withdrawal, low spreads, and offer a good amount of leverage, right? So, but like I mentioned, these brokers that are legit, usually they offer high flexibility, bigger bonuses, and even higher leverage, like I mentioned. So, but others, they can be outright scams, manipulating prices, sometimes delaying withdrawals, or even disappearing overnight with traders' funds, right? So I have gone through many with those sort of brokers before. So the question is, risk or reward, right? Is the extra flexibility worth the potential danger? And that's what you need to think about before choosing a broker. So the next slide, I will break down the pros and cons so you can make the right choice for your trading journey. Okay, so let's get into it. Why should we choose a regulated broker? Let's break down the biggest advantages, especially the pros, right? So first, your funds are protected. So it means regulated brokers must keep your money in segregated accounts, meaning they can't touch it for their own use, right? Even if the broker goes under, your money stays safe. Second, fair trading practices. No shady price manipulation, no unfair execution tricks. Just a level playing field where your trades are executed as they should be. Third, dispute resolution. If something goes wrong, you're not alone. Regulators can step in to investigate and even help recover lost funds in some cases. And finally, better transparency and security. So, regulated brokers have stricter guidelines to follow, regular audits, and clear policies, so you always know where you stand. At the end of the day, trading is already risky, so why add the unnecessary risk with a shady broker? Stick with a regulated one and focus on what really matters, growing your account safely. Right, so let's talk about the downside of regulated brokers, because let's be real, nothing's perfect. Okay, so first, you've got lower leverage. Due to regulations, some brokers, like those in Europe, offer a maximum leverage of 1:30, which can be limiting if you're used to higher leverage for bigger trades. Second, there's the KYC, know your customer process. So stricter regulations means stricter verification, which means you'll have to submit personal documents such as your ID, proof of address, maybe even a selfie, just to get started. It can feel like a hassle, but it's done to protect you and ensure no one's hiding behind the screen. And finally, geographic restrictions. Some regulated brokers simply won't accept clients from certain countries because of legal reasonings. So dependent on where you're based, that could be a deal breaker. While this may seem like a drawback, keep in mind they're designed to keep things secure and transparent, which ultimately means more peace of mind for you. But if you're willing to deal with this limitation, a regulated broker could still be the right choice for you. Pros of non-regulated brokers. And yes, there are some upsides too. Okay, so first of all, offers higher leverage. We are talking up to 1:500 or even more. This means you can actually control a larger position with a smaller deposit, and for some traders, this is a game changer, allowing them for bigger trades and potentially larger profits. Now, second, fewer restrictions, right? One of the second pros is fewer restriction. Non-regulated brokers tend to have easier account openings, and their withdrawal processes are often quicker and more flexible. Plus, you won't have to jump through hoops for the KYC process or provide piles of personal documents. And finally, it offers lower fees and spreads since they aren't bound by all the regulations that regulated brokers face. Some non-regulated brokers can offer tight spreads and lower trading fees. Now, while these advantages sounds great, remember, higher risk comes with these benefits. But if you're looking for more freedom, flexibility, and potentially better trading conditions, non-regulated brokers might be worth considering. About the cons of non-regulated brokers, because there is always a trade-off. First up, there are no legal protection. Without regulation, there's no watchdog to step in if things go south. If they scam you or disappear with your funds, you're basically on your own. No regulator to back you up. There's no safety net. Okay, that's first. Secondly, price manipulation. Some non-regulated brokers engage in dirty tricks like stop hunting or slippage, where they manipulate the price to trigger your stop loss or cause your trades to execute at worse prices than expected. It can be really frustrating and could cost you big time, right? And last but not least, your funds are always at risk because there's no oversight, there's no guarantee your money is safe. A non-regulated broker could literally just disappear overnight, and all your hard-earned cash could be gone without a trace. Now, while a non-regulated broker may offer higher leverage and lower fees, the risk is something you can't afford to ignore. It's a high-stakes game. Which one should you choose? Alright, so if you're serious about trading and you want that peace of mind, knowing your funds are safe, then a regulated broker is the way to go. Because the security and transparency are key here. And you can rest easy knowing that regulators are keeping their eye on things, right? But hey, if you're chasing high leverage and more flexibility, a non-regulated broker might seem very tempting. The lure of huge leverage and potentially lower fees can definitely catch your eye. But remember, with those rewards come higher risk. It is a gamble and you need to be aware of that. So pro tip is, before you jump in with both feet, always do your homework, check reviews, test withdrawals, and start small before you commit any significant capital. This way, you can mitigate your risk and get a feel for the broker before going all in. I mean, better safe than sorry, right? So, it's all about making an informed choice and positioning yourself for success, whether or not you decided to go for the regulated ones or the unregulated ones. Okay, let's dive into pips. And this is one of the most important concepts in Forex trading. Alright guys, so a pip stands for percentage in point or price interest in point. Simply put it as the smallest unit of movement in a currency pair's price. Now for most currency pairs, a pip is equal to 0.0001, which is 100th of a cent. So if you're trading something like Euro USD and the price moved from 1.1000 to 1.1005, that's a 5 pip increase. But here's where things get a bit different. When you're trading pairs involving the Japanese yen, JPY, a pip is measured at 0.01. So if USD JPY moves from 145.50 to 145.80, that is a 30 pip move. Usually you can find it on the 4th decimal point. Now, why do pips matter so much, right? Well, pips are the key to measuring your profit and loss. The value of a pip depends on your lot size. For example, with a standard lot of 100,000 units, 1 pip is worth $10. With a mini lot of 10,000 units, 1 pip is worth $1. Understanding these pips right is crucial for managing your risk and calculating your gains. Knowing how much you stand to gain or lose with each pip move is an essential part of building your strategy, your trading strategy, and setting realistic goals. So, mastering pips, it is one of the most absolute key to your trading success. Lot size, right? It is important, because you are going to apply it every time you're taking a trade, and it is very important. Okay, so in Forex trading, lot size refers to the number of units you're trading in a currency pair, and it directly impacts your risk, profit, and loss on each trade. And there are 4 main lot sizes for you to keep in mind. They are the standard lot, which is 100,000 units. There's a mini lot, which is 10,000 units. There's a micro lot, which is 1,000 units. And then there's a nano lot, which is 100 units. Now, for a standard lot, each pip movement is worth $10. Right? Each pip movement is $10. So usually for a standard lot is 1.00. So if you trade Euro USD with a standard lot and the price moves 10 pips in your favor, you're looking at $100 profit, because 10 times 10, right? But if it moves against you, you'll be facing $100 loss. A mini lot, each pip here is worth $1, which is 0.01. The risk and reward are lower compared to the standard lot, which might be a good fit for traders with smaller accounts or more conservative strategies. If you are applying a more conservative strategies, this would be a good amount, right? And so it's the same thing. So if it's a 0.10, which means a pip move is $1, and then the pip moves 10 pips or 20 pips, let's say 20 pips to your take profit level, means you are looking at $20 profit, and if it goes against you, you're looking at $20 loss. Micro lot is 1,000 unit. Each pip is worth just 10 cents. Okay, giving you even more flexibility with your risk management. It is also a great option for beginners or those who want to test strategies with minimal exposure. The last but not least is nano lot, which is the smallest, 100 units. Each pip movement is worth just 1 cent, making this the smallest risk. If you're just starting out or want to practice your skills without risking too much, this is the way to go. So now, here's the key. Choosing the right lot size is all about understanding your account size, which means your capital, your risk tolerance, and your trading strategy. The amount you're willing to risk per trade should dictate the lot size you use. If you are not careful, you could end up risking too much too quickly. That's why risk management is so important. Always calculate your lot size based on how much you're willing to lose and stick to it. If you master this, you'll be well on your way to consistency and profitability in the Forex market. So example, right? Let me show you an example. Example, if you have $1,000 account, right? And every trade you take, you are only willing to risk $10 or $20, right? It would be much logical for you to take a mini lot, which is a 0.1 lot, rather than the 1.0 lot, because you have a bigger room for risk, at the same time a calculated one. Because if you were to take a standard lot, every pip move is $10, means you can only afford to risk 2 pips. But if you were to take in a mini lot, you can afford to risk 20 pips, right? You can afford to risk 20 pips for it to hit $20. So there's a bigger room for you to play, and then there's your mind is much more clear. You're not too stressed about, because price fluctuates. 1 pip, 2 pip movement is very quick. It's very quick. So that's why understanding lot size, the amount you want to risk, is very important. Understanding pips is also very important, because when we trade in the Forex market, we based our stop loss and our take profit levels on pips, right? 1:2, maybe 1:1, 1:3 risk to reward ratio. So just remember, the lot size you choose directly affects your trading journey. So you gotta stay smart, always plan ahead, and trade responsibly. Spread and leverage. Okay, these are the 2 key factors that actually impact your Forex trading. But first, I want to talk about spread. Okay, so the spread is the difference between the buy price, which is bid, and the sell price, which is ask, okay, of a currency pair. Think of it as the cost of entering a trade, kind of like a small fee you pay to the broker every time you open a position. Now, spreads aren't fixed. They change depending on market conditions, liquidity, and volatility. Tight spreads are better. Okay, this is just a small difference between bid and ask, means lower trading cost and usually ideal for active traders. Wide spreads, larger difference, means higher cost and usually happens during major news events low liquidity times, or highly volatile markets. Let's say you're looking at Euro USD and the bid price is 1.1 thousand, while the ask price is 1.1002. That's a 2 pip spread. This means you start your trade 2 pips in the negative, and the market has to move at least 2 pips in your favor before you actually break even. Okay, so brokers make money from spreads, especially market makers who don't charge commissions. Some brokers offer fixed spreads, while others have variable spreads that widen based on market conditions. So this is why it's important for you, and especially if you're getting into trading on a daily basis, getting good at it, trying to find your edge and stuff, you need to find a broker that offers you lower spreads, lower spread law, lower fixed spreads. That will help you in the long run when it comes to your trade, right? Because it's an important factor, especially when you're entering a trade. Because remember, the wider it is, the more the market has to move before you see profits. So let's say you buy at this position, means your entry price won't be exactly at that position. You might need to make a few pip move depending on the spread before you can actually start seeing the profits if the trade goes in your favor. Okay, and then the next one we are going to talk about leverage. Okay, so leverage, right? This is what actually allows you to control a larger trading position with a smaller amount of capital. So that's what the brokers are there for. For example, if you sign up an account under a broker that offers 1:100 leverage, you can control $10,000 worth of trades with just $100 in your account. This $100 means what you deposited as your base capital. Sounds great, right? But here's the catch. Leverage amplifies both profits and losses. If the trade moves in your favor, you can potentially make big gains. But if it moves against you, you can lose more than what you invested if you are not careful. That's why it is important that you understand your risk. How much you're risking per trade. What are the lot size you're using based on your capital? How many pips movement? What's your risk to reward ratio? All of this plays a huge important part as a trader. Okay, so you have to understand that. So you use your leverage wisely and don't get caught up in the excitement of like big positions without proper risk management. And always factor in the spread whenever you're planning your trades. It is the hidden cost that can make or break your strategy. And if you master these two concepts, you are one step closer to becoming a smarter and more profitable trader. Okay, so before actually diving into technical analysis, you need to understand the four main chart types that traders use to read price action. Okay, it is very important. First up is the candlestick chart, one of the most popular charts in Forex. Okay, next, the line chart, simple yet effective, and then we have the Western chart, also known as the bar chart. And finally, the Renko chart. Now, this one is unique. Candlestick chart. Okay, so when it comes to analyzing price action, the candlestick chart is what I would call a trader's best friend. Right? It's the most popular chart type because it actually gives you a clear and detailed look at market movements. Each candle tells a story. Now, if it's green or white, buyers were in control, pushing price higher. If it's red or black, means sellers dominated, right, driving prices down. Candlesticks don't just show where prices opened and closed, but also it shows the highest and lowest point that it reached during that point of time. Cool. Because I personally, I use candlestick charts a lot, right? Basically, we all do. The real magic is patterns. Candlestick formations usually help us traders to spot potential reversals, continuations, and shifts in momentum. If you master this chart, it will not only help you in your trading journey, but it will also help you to sharpen your ability to read the market like a pro. Now, candlestick. When do we use it? Understand that it is basically a go-to for traders who actually love the trade price action and spotting patterns. It is perfect for scalping, day trading, or even swing trading because it gives a clear view of market sentiment. Who's in control, buyers or sellers? With candlesticks, you can actually recognize bullish or bearish momentum, making it easier to time your trades. Plus patterns like doji, engulfing, pin bars, hammers, etc. It gives us a strong clue about potential reversals or even continuations. Yeah, but this part of candlestick, there is more to it. So you have to do your research, and I would consider to actually be making another video on all the different type of candlesticks. All right. So if you want to level up, just remember that combining candlestick analysis with support and resistance will help you a lot. Okay, and you will start seeing the market with a whole new perspective. So when is not ideal for us to use it? Okay, just understand that candlestick chart is powerful, but most of the time, especially for beginner traders, right, is not always the best choice because you are just starting off, and everything is very foreign to you. And if you're someone who has been trading, or like I mentioned, a beginner, and you prefer a cleaner, less cluttered view, these candlestick charts can sometimes feel very overwhelming, especially with all the rapid price movements. So if your focus is purely on strength, like the trend strength, rather than individual candle patterns, other chart types like line charts or Heikin-Ashi might be better suited for you. But overall, it all comes down to your trading style. If you love price action, like me, and reading market psychology, candlesticks are great, right? So I highly recommend to get good at it because it will help you as your trading journey goes on. But for a start, or even if it's not something that you like and you need simplicity, there are other options for you to choose from as well. Now we are going to talk about the line chart. Okay, so the line chart is the simplest and cleanest way for you to view the market. It connects closing price with a single line, making it easy for us to spot the overall trend at a glance. But here's the catch. Okay, it doesn't show detailed price action like highs, lows, or candlestick patterns. So while it is great for big picture view, it might not be the best for short-term trading decisions. And for a start, if you want clarity and trend direction without noise, the line chart is a better choice for you. When do we use line chart? So the line chart is perfect when you want to keep things simple and focus on the bigger picture. It's also great for spotting trends without the distraction of individual candlesticks or price fluctuations. So it's much more clear, but I would say it is more likely towards a swing trader or a position trader because it actually helps you to see the overall market direction, whether it's an uptrend, downtrend, or range bound market. When you need clarity over complexity, the line chart is definitely your go to tool.
So when it is not ideal. Now, it's important to understand that line charts don't show price waves, opens or closes. So if you're someone who trades short terms or you scalps the market, you'll be flying blind on key price action details here. And in short, if your strategy fully relies on precise entry and exit points, line charts alone won't cut it. So you'll need candlesticks or other chart types for full clarity. Right. So let's talk about bar charts, which known as the Western chart. Now, each bar on this chart shows you four key pieces of information, which are the open, high, low, and close. We call that OHLC. The left tick marks the opening price, and the right tick shows the closing price. And the vertical line, it represents the high and low of that period. It gives you the same important data as a candlestick, but in a cleaner, more minimalistic format. If you like reading price action without too much noise, bar charts can be a great alternative to candles. Simple, sharp, and to the point, just like how traders should think. So when should you actually use the bar chart? Alright, so you use it when you want to clearly see the open, high, low, and close without the extra distractions that comes with candlestick colors. Bar charts give you pure price data in a clean and structured format. There's no green or red candle drama here, just raw movement. A lot of professional traders love bar charts because they focus on precision and price action, not visual noise. If you're someone who trades based on structure, levels, and clean data, bar charts are your friend. Alright, so when is it not ideal? Now, bar charts aren't actually for everyone. If you're someone who prefers visual clarity, candlesticks might actually suit you better, but charts can feel a bit more technical or harder to read, especially for newer traders. There's no color coding, and the open and close are just tiny ticks on the side of a line. So, if you rely on visual patterns or want to spot bullish and bearish momentum fast, candlesticks give you that edge. More intuitive, and I would say more visual. Okay, next up is our Renko charts. This one is a bit different. It completely ignores time and focuses only on price movement. Each block or break is formed only when price moves a certain amount, no matter how long it takes. What does that mean for you? Now, it filters out all the small noise and helps you see the bigger trend more clearly. No distractions, no choppy sideways candles, just clean direction. Renko charts are powerful when you're trying to catch or stay in trends because they make reversals and continuations a lot much more easier to spot. Right, so when do you use a Renko chart? Right, you use it when you want to cut out market noise and just focus on real price movement. It is perfect for trend following strategies because it helps you spot reversals and continuations more clearly than traditional charts. Since Renko doesn't care about time, only price, it's great for traders who don't need minute by minute candles. If your goal is to follow clean trends and ignore sideways chop, Renko gives you a much cleaner picture of the market. Right, so it's important to know when it is not ideal to use Renko because Renko isn't for every situation. If you need precise entries and exits based on time-based price action, Renko might actually hold you back because it doesn't factor in time. You can't see how fast or how slow something is happening, just that it happened. And if you trade news events or volatile markets such as gold, Renko may lag behind the action. It waits for price to move a set amount before printing a break, which means you might miss key fast moving setups. So while it's great for trend clarity, it's not the best tool for high-speed decisions. So, which chart should you be using? If you ask me, if you're a beginner or trading with a long-term perspective, start simple. The line chart gives you a clean overview without any distractions. And if you prefer a structured view of OHLC data without the colors, then the bar chart might be your thing. Clean and to the point. If you're a price action trader just like myself, reading candles, patterns, and market psychology, then candlestick charts are your go-to. That's what most forex traders use, and for a good reason. As for me, I only use candlestick and line charts most of the time, a combination of both. Now, if you're into trend following and want to cut out noise, raincoat charts are super useful for highlighting trend direction and clarity. At the end of the day, it's all about your style. Candlesticks give you detailed price action, raincoat shows trend, and line or western charts are great if you want to keep it simple.
The three pillars of market analysis. In trading, there are three core types of market analysis you need to know. Let me break it down for you. The first, technical analysis. This is all about using price charts, patterns, and indicators to understand market behavior. Traders who use these believe that history repeats itself and that price often follows predictable patterns and trends. 2. Fundamental analysis. This looks at the economic, political, and financial factors that affect a currency's strength. Unlike technicals, fundamentals focus on the why. Why is the market moving in a certain direction? It's about interest rates, inflation, employment reports, the real world forces behind the chart. And lastly, sentiment analysis. This is where you tune into market psychology, how traders feel about a currency or an asset. It's not just numbers, it's emotion, perception, and herd behavior that can drive price in ways logic can't always explain. Now, here's the real tip. If you want to become a truly skilled and consistent trader, don't just stick to one. Learn and master all three. Because when you combine technical setups with fundamental context and sentiment timing, you're not just guessing anymore. You're trading with confidence, clarity, and edge. And that's a skill no one can take away from you. Thanks for watching. I hope this content has brought you real value. And just quick reminder, everything shared here is for educational purposes only. This is not financial advice. Trading comes with risks and it's not for everyone. Gold Stallion exists to equip you with real skills, from strategy and risk management to the psychology and discipline needed to succeed in the markets. If anyone reaches out claiming to be from Gold Stallion asking for money, offering to manage your funds, or requesting transfers, that's not me. I don't offer investment services, and everything I provide here is 100% free. If you found this helpful, I really appreciate it if you subscribed, hit the like button, and share this with someone who wants to learn the right way. And if you'd like to stay connected, all my socials are linked in the bio. Feel free to follow and reach out. Stay sharp, stay disciplined, and I'll see you in the next video.